Good afternoon. I'm Doug Bartole, President and CEO of InPlay Oil Corp. We're based in Calgary, Alberta, Canada. We're a junior oil and gas producer. We're focused on light oil plays, conventional plays in the Western Canadian Sedimentary Basin. You know what, with that, I'm going to jump right into our corporate presentation and give you an update with our first quarter, not a full quarter with our new acquisition, but just about a full quarter of our acquisition that we announced back in February. So, our corporate strategy is to be a disciplined light oil company, producing our high rate of return assets, focused on free adjusted funds flow growth, conservative leverage ratios, and maximizing returns to our shareholders. So the deal we just did, it increased our scale and the quality of our company significantly. We estimate for the rest of the year, when we announced this, over 18,750 BOEs a day from April 8th forward when we took over the production. But more importantly, over 9,300 BOEs a day of light oil. Makes us the largest Cardium producer in Western Canada. We have very strong adjusted funds flow, free funds flow. And we were able, from the time we announced in February until when we put out the forecast after getting some history with the assets and the new drilling in the first quarter, we were able to reduce our capital 30% for the rest of the year to get these same production numbers. Now, we'll talk about the accretion, and we got some great slides specifically in the presentation on that. This deal enhanced our sustainability. Our PDP decline rate of 24% is very important for our strategy of paying back dividends, paying down debt. Large, long PDP reserve life index of over 7 years on approved basis, 13.4 years. Now, most importantly, we added a lot of tier 1 locations. It changed the history of our company, our long-term look, by giving us 10 to 15 years of what we would consider tier 1 inventory. Today, our dividend is just under 10%. It's $1.08 per share paid monthly. It's supported by approximately 2.5 times of our free adjusted funds flow, that base dividend. Then we've paid about $52 million since we started that dividend in November of 2022. And again, keeping a strong balance sheet, we expect to be around mid-range guidance, 1.2 times net debt to Q4 annualized EBITDA, with somewhere north of $35 million in debt reduction by the end of the year. And we got a strong hedge position, which I'll talk about. So let's go through Q2 real quick. We closed the synergistic and highly accretive acquisition of the Pembina Cardium assets that, like I said, we took over production on April 8th. We had 20,400 BOEs a day in the first quarter, at about 62% light oil and natural gas liquids. That's easily 1,000 barrels ahead of our forecast. It's a 125% increase from our first quarter when we were on a standalone basis. And just about as importantly, it increased our light oil weighting 35% from Q1 2025, because that is our main driver of revenue and cash flow. After the quarter, we've now guided to the upper end of our production guidance, and we'll go through that on the forecast on a specific slide. You're going to see, we had adjusted funds flow of over 40 million and free adjusted funds flow of 35 million in that quarter. So $1.49 per basic shares adjusted funds flow, and free adjusted funds flow $1.32 per share. We reduced debt by 26 million from the close of the acquisition, approximately 5 million more than anticipated. And our quarter annualized net debt to EBITDA is already in the mid-range of our guidance at 1.2 times. And then you get into our drilling. The H1 25 drilling that we had done is about 135% of our type curve, based on the first 4 months, initial production over 120 days. So we're showing 6 of those 7 wells because they're on pads, and we're averaging the pads. Now, the best pad was spectacular. This was drilled with our involvement, but prior to the close of the acquisition from the other party. Those wells are 300% above type curve. And as you can see, very little decline over the first 4 months. They're just starting to decline a little bit now. So then the 14 to 33 pad that was on InPlay lands, great results there as well. Those are 75% above type curve. And I guess these are all in-play lands now, but that was drilled in the first quarter that we did. And then the 801 again was came in on the third party, and that's even still great at 25% above our type curve. I mean, if everything could be as good as 25% above our type curves, we're going to be in great shape going forward. The other really interesting highlight is we welcomed the Delek Group as a 32.7% strategic shareholder. So they purchased the shares from the vendor that sold us this acquisition. These guys have a huge history in the oil and gas industry and a value creation in the sector. They grew Ithaca Energy from 29,000 barrels to 120,000, or they helped in growing them to 120,000 barrels a day in the last 6 years. They are also 45% owner in the largest natural gas field in the Mediterranean, where there's something like over 23 TCF of recoverable gas in that field. So again, great knowledge, great shareholder. We're excited to have them joining us, and we're very strategically aligned on what we want to do together as we move forward. So we're now the largest producer in the Cardium. Of course, the Pembina Cardium is the largest conventional light oil pool in Western Canada. 11 billion barrels of rich oil in place. I mean, our lands were in yellow. Some of them were on the fringe. The acquired lands are in the orange. And this is a great map because, you can see all these gray lines are the horizontal well development in the Cardium over time. From the fringes, moving towards the center of the pool, both on the east side and the west side. But the assets we purchased now makes us the biggest landowner and the biggest producer in the Cardium. You can see way underdeveloped. Lots of locations to continue to drill. You can just see all the holes that we have and the opportunities we have for the next 10 to 20 plus years here. I think we'll move on from this slide. And when you take a look at the key financial metrics of the acquisition, right off the hop, it was 40% accretive on adjusted funds flow per share. I think we went from give or take $4, a little over $4 to $5.50 to $6 on a funds flow per share. Extremely accretive. This is a low decline asset. Doesn't take a lot of capital to keep it flat. It increased our free adjusted funds flow by 65%. We paid about 0.5 times the PDP, net present value before tax at 10%, and about 2.2 times net operating income. So really, really great asset. And this is the kind of free funds flow that this asset would generate at these different commodity prices. And if you look at WTI $65 in the middle, it's about 80 million. So perfect asset in our backyard. We're very confident that we are, the most advanced drilling and completions guys in this area due to our focus on that area. Again, synergies. Let's just start from the bottom left. On the corporate side, we see we added more than 120% to our production, and we're adding less than 50% to our staff. We get better interest rates being a larger company. Things like that all help add up to those synergies. Dilutes your office space rent, everything like that. So just common synergies on the corporate side. Operating, another $4 million of synergies. Us just tying in production that we are currently trucking into those facilities will make up most of that. And we'll see more of that over the years as well as we continue to drill and grow the new asset base. Then on capital, just in general, this is our focus. This was not the other company's focus. We've drilled wells with them. They've drilled wells for us. We're typically upwards of 15% cheaper drilling and completing these wells. And just how we do development of facilities and infrastructure as well. Again, just due to a focus of this play and us being specifically focused on this play for the last so many years and with 85% of our production there. Just if you take a look at our corporate guidance, an important slide, Mid-range of our guidance is 130 million, give or take. I think, we're there now on the high end for the rest of the year on current strip pricing. We've estimated capital expenditures of 53 to 56 million dollars. We've announced at the end of the second quarter it'll be 53 to 56 on the lower end is where we expect to be. And then our base dividend for the year is around $26.5 million. So that leaves about 46 million of excess free adjusted funds flow. And the key to that right now is just pay down debt as much as we possibly can by the end of the year. It's simple math. I mean, every $28 million in debt we repay, that gives us about an extra dollar per debt adjusted cash flow per share number. I mean, a 3 times multiple is worth about $3 on a share price. So by far and away, it's the best place to put our excess free funds flow as we see it right now. And of course, less debt, pay less interest. So it's a double whammy to focus on paying down debt. So when we take a look at the inventory, we have, what do we have here? 400 plus wells of locations. I think there could be more as time goes and you continue to delineate this. But tier 1 inventory, $70 WTI, less than 1.5 years payout. That's about half that inventory. We're going to drill, 5 to 5.5 more for the rest of the year, which will be 8 to 8.5 for the year, which is great because it's less than what we were expecting. And to drill, which again helped reduce our capital, to get the same or better guidance. So outperformance is spectacular. Now that inventory took us from kind of 3 years, 4 years of tier 1 inventory to 10 to 15 years of tier 1 inventory. And again, when you're drilling, give or take, it could be, it's from 10 to, mid to high teens. That's great. What the good part is? There's still another 200 locations. And those locations right now, we don't consider them to be tier 1 inventory. Some of them, as we delineate, will move into tier 1 inventory. But a lot of the other ones, I firmly believe, down the road, when oil prices are going to be, much higher, $80, $90, maybe $100, those will start be paid out in 1.5 years as well. So a great acquisition, changes the whole outlook and the sustainability of our company. Now, I think we did put this out in our original presentation on the acquisition. This is just a little bit about our well design. We've been the leaders in drilling and completions in the Pembina, in the Cardium in general. And when you take a look at the charts, I think that's the easy way to go. You got a lot of wells that were drilled over time. Now, if you look at the production on the left, barrels of oil per day, the red to orange line is in play. And we were drilling here a lot before COVID. We got an offset operator who's in the middle of the pool. They started drilling after COVID, and that's the blue line. Now you can see our IPs are similar, but their decline rates are lower than ours. That's because they're in the gray. They're more in the center and some of the best reservoir in this pool. We were a little bit fringier. So because of our drilling techniques, we had the same IPs as the offset operator in gray, but we declined a little quicker. We believe that the new assets that we acquired, which are on the bottom here and they're purple, these assets are in the center of the pool in some of the most undeveloped, highest quality reservoir in Pembina. And again, they were not drilling the same as us or the offset operator. The offset operator did their work. They looked at the drilling completions of other people. They basically copied our drilling and completions. And you can see directly across from the production stage of spacing. InPlay, we're only going back to Q1 of 2020, but we were drilling before. We're typically under 50 meters per stage on our fracs. You can see the offset operator that's in the gray lines with the blue diamonds. They basically mimicked us right from the beginning. The assets that we bought, they were up here in the 90 to 100 average, and they've been slowly working their way down to match more what ourselves and the other offset operator have been doing. So again, our drilling completion techniques, we expect great results, in a much higher quality reservoir. In fact, we believe it's the best remaining reservoir in the Pembina Cardium. So pretty excited. Ultimately, that allowed us to add more sand in our fracs on these wells by the tighter spacing that we do. I'm not going to spend a lot of time here. Corporate overview. Again, we talked about being on the higher end of our guidance after the H2 release. Drilling another 5.5 net wells this year. Again, lots of reserves here. I mean, on a proved plus probable value basis, you got $1.4 billion of value. We got a market cap at $11 a share of about $36 million, $529 enterprise value, just under a 10% yield, and pretty strong liquidity. Like you're seeing easily kind of 1.5 to 2.5 million a day of shares trading on us. Now, year-end net debt, this would be on the high end of our guidance at $217 million. And we got over $300 million of lending capacity. With the employees and directors owning about 3% and the large inside shareholders who are on the board owning 46%. So nothing has changed with our management team. We promoted one person to VP Engineering, who's been very instrumental in everything we've been doing in the last 2 or 3 years. All of our directors have remained the same, with Craig Golanowski, who's with Carbon Infrastructure Partners, is about just under 12%. And of course, our new members from the Delek Group, Udi Iraz, the chairman of the Delek Group, and the CFO, Tamir Polakar. So really great additions to the board, and as I mentioned, strategically aligned. I'm going to rip through these pretty quick. They've been in our presentation all the time because we're very proud of the fact that we've grown our production continually since we went public in 2016. I mean, there's ups and downs, but over time, that's over 255%. You're going to see another 15% per share growth in 25, and it'll be again strong per share growth in 26. And that's what the blue squares are here. Green being our light oil production, orange is natural gas. And it's the same with reserves. We'll grow reserves about 16% in 2025 on a per share basis. That's the blue squares here. We'll do that while still, we believe, adding top quartile reserve adds and capital efficiencies. So whenever you grow production and reserves on a per share basis, ultimately you create value for your investors. And prices and the commodity prices are going up and down, and they're part of it on any given day. But over the long haul, as long as you don't blow things up, you keep the debt in line, you will create solid value. Again, just how the funds flow went over the years, and the blue box is a funds flow per share basis. Of course, 22 is probably the best commodity year I've ever been involved with in the industry, and I've been doing this for, I believe, about 34 years. But again, we're going to have, with not quite 3/4 of a year, the new assets, over 125 million. Again, that's the low end of our guidance. And again, significant free adjusted funds flow. We've got the debt up a little bit to do this deal, but we'll be driving that down significantly by the end of the year to less than 35 million. I'm going to skip our history of previous add-on acquisitions because we've talked about it in a while, but the bottom line is value add in these 2 acquisitions has been significant for us, including the first one we did back in 2020, which has now had over 62.5 million of free cash flow derived from that asset. And we're just getting to the point of free cash flow on the little bit larger Prairie Storm asset. But it added, in each case, the one done in 2020 added about 90 times on a value on a 1P basis, or over 6 times on the Prairie Storm acquisition. This new asset is a huge free cash flow asset, and it'll be, we'll grow it accordingly on price, very disciplined capital deployment based on commodity prices, but typically looking in the 3 to 5% range of growth. Now, again, just some reserve highlights, net asset value. I mean, we're now trading a little over $11. I mean, still significantly below our proved developed producing B410, 10% net asset value of $17+. You know what? I believe we'll get there. We will see multiple expansion. during the next cycle, which is going to start putting us towards a lot closer to the approved developed producing that asset value base. And at times historically, we've actually been a lot closer to the total proved case. So it'll be interesting to see that in time. And, if you're starting to get $6 a share and higher prices, $7 a share in AFF, and you start getting, 4 or 5 times cash flow multiples on that, that's how you see getting to $30 here. The forecast, again, pretty quick. High end of the guidance. WTI price, I guess we used actuals to the end of July, and we're still using $60 for the rest of the year. We haven't changed anything else on the pricing. High end of our production guidance, low end of our capital program. Mid-range of our guidance is 129 on adjusted funds flow. I can see that being on the higher end of that range, giving us free adjusted funds flow of 72%. Free adjusted funds flow yield of 24% is one of the highest of all of our junior, slightly larger junior towards intermediate peer group. It's one of the highest free funds flow yields out there. So in general, we're pretty confident that should be coming down more, getting more in line with our peers. And then the debt, I would say at this stage, we'd be on the lower end of our debt by the end of the year as well. So we have some mandated hedges after the facility, about 75% of net after royalty oil production hedged for the remainder of the year. And it's actually slightly higher on a natural gas basis. Natural gas is hedged over $2.10 through the summer, which is great because we're currently been hovering in the $50 to $70 a GJ range, which happened last year. And we have strong hedges in the natural gas as we stand today. That's it. I'm going to leave it here. I know Jasper's going to have some more questions for it, but we're excited where we stand, and the long-term position of our company is extremely favorable and in a great position. And I'll stop there and to Jasper talk.
Well, a great presentation, Doug. So let's start with, could you tell us who you are and tell us a little bit about your career?
Well, I'm an engineer by trade. I've been in this industry for, give or take, I kind of forget, but 35 years now. I've done pretty much everything in this business. As I said, on from starting out in operations, completions, exploitation, A&D, facilities. I've done all that. The only thing I never did was I was never a pure driller. It's a little bit of a different beast, but it's also very focused. I wanted to always learn and be involved in the bigger picture. But I've worked for companies like Pan Canadian Petroleum, Renaissance Energy, Husky Energy for a little while, True Energy, which trusted, and then we spun out Vero Energy, which I became the president of. I think that was around 2005. So I've been president of companies now for about 20 years. We sold that Vero in 2012, and we started InPlay right away. Started privately and worked our way to a public company in, I guess, November of 2016. And it was initially meant to be a 3 to 5 year plan, and here we are, 9 years later. But actually, probably in the best spot we've ever been. So
yeah, I gotta say, Q2 was just released, and that was a great quarter, and almost all of the quarter, besides like a week, was with acquired assets. Net debt reduction reduced by 26 million, 35 million of free cash flow. And you had a production above I think it was 20,400, of which 62% liquids. Maybe you could tell us, did the acquisition or the integration of the assets go as smooth as you thought? And maybe you could talk a little bit about Q2 as well, and your expectation versus outcome.
Yeah, the integration went great. Operationally, it was spectacular. A little bit more work on the financial side. As you can imagine, there's different computer programs doing financials from one side to the other. So you got to start putting it all together. It's the same with production side and everything. But again, just our focus on the operations and production in the area and in the Cardium in general, that helped the operations a lot. We did not receive a lot of people on the financial side from the other from the vendor, from Obsidian, and ultimately, so we had to do a lot of hiring. And again, I'm extremely proud of our people and how they handle it, and put everything together for the quarter. While significant amount of hiring of people and everything to make it all go smooth that was occurring. So it was a busy time, but I mean, our people were spectacular on that. As far as production, I mean, we modeled it back in February. We announced. Then we put our forecast out just after the Q2 numbers on May 8th, which pricing was down from 72 to low 60s. But the good thing is because we could see the outperformance as we had some history with the assets, we were able to reduce our production or our capital by about 30%, which was important because, again, our key was always to get our debt down closer to 1 as soon as possible, debt to EBITDA. And so that's worked out. We originally had modeled in this a lot less than like 20,400. I mean, we're saying it's 1,000 barrels over our remodel, but we were actually in the 18s when we first modeled this back in 18,000 barrels for the quarter back in February, due to the great performance and even the base is doing better than we expected. Now, one last piece there is like if we even had that extra 7 days of production for the full quarter, that would have added 1,000 barrels to our quarter. So, of course, it got adjusted within the purchase. It's going to get adjusted in the purchase price because the date was December 1st. So, but again, like we are tickled. I guess it's easiest to leave it like that at this point. So
fantastic. So on the drilling side, I mean, you didn't drill in Q2. You started drilling in August. I think as of Q2, by the way, your production was around 19,600. So good for the viewers to know that. And you're drilling 5 to 5.5 net wells this year, or then from now until the end of the year. Where are you looking to drill, and when should the wells roughly come on stream? Impact production.
Yeah, so we start. Yeah, good question. I mean, we just started drilling after the long weekend here. I can't remember. It was the 4th, I think, was the Monday. We started moving in and drilling on the 5th of August. It's a 3-well pad. It's a long pad. It's over 2 miles per well. The wells are long. It's in a great area. That we're excited about after looking at logs, offsets, pressures, everything. So pretty excited to get those on. Now we had to do a bit of a gas plant upgrade in one plant, and that's all projected to occur by the end of September, which times perfectly for these new wells coming on at the end of September, early October, somewhere in that time frame. And then we're going to drill another couple wells in our PC Unit 7 area. That's the asset we acquired from ARC back in 2020, and they'll start kind of beginning of October, and I would imagine, and we have a little bit of flexibility on that. They'll come on, in the beginning of November. We could make it a little bit later. It's a tiny little bit gassier area, so again, nicer to get it into a winter gas price environment than the current poor pricing we're seeing right now.
Yeah, that's true. So that's good. You got some flexibility on that side. Maybe you could also mention, talk a little bit about unbooked locations on the acquired assets and potential to grow reserves from there.
Well, I mean, I don't have it on acquired assets, but I mean, we have 407 locations. Give or take 248 are booked, are approved. Got 35 approved plus probable, and you've got 120 some unbooked. I guess, like I say, just in general, like it just improved our tier 1 inventory massively from a standalone basis of 3 to 4 years to 10 to 15 years. So it just gives us lots. Again, and the 10 to 15 is depending on how what the commodity price is and how aggressive we are in drilling on any given year. And, bottom line is, there's another set of wells there too that are longer than 1.5 times tier 1 inventory. And those wells at higher prices will start paying out in less than a year and a half too. So if your view is like mine, that ultimately, oil is going to trade at a higher price and stay there, we have a lot of inventory for quite a few years.
So Delek Group, Delek Group bought Obsidian's energy stake in InPlay. So essentially took out that overhang. They bought at $10 a share and now holds a third of the company. Could you give us an overview who the Delek Group are?
Yeah, I mean, and I kind of mentioned it, but like the Delek Group, it's a conglomerate company in Israel. They trade on the Tel Aviv Stock Exchange. They also have other investments, but like their oil and gas portfolio is one of their main investments. I mean, they're 45% owner in the largest gas field in the Mediterranean that's supplying gas to Jordan, Egypt, Israel. I think they just announced a large deal for selling gas to Egypt. I can't remember, 4 or 5 or something BCF of gas to them over the next so many years. Like spectacular play. Getting prices, I don't know, 2-3 times more than what we get in Canada. And then, of course, they were part of Ithaca. They were involved with Ithaca when they were around 19,000 barrels. They took them private. They brought in some other assets. They went public again in 22, and then they just merged with E&I. And they're still 52% in 120,000 barrel day company. They're looking at expanding more in oil and gas. They looked at Canadian jurisdiction, and they thought it was a good place to be for a few reasons. Like, even though we get frustrated with our politics and our governments, they still think it's a relatively stable place. Like, I mean, the UK and the North Sea, a lot of places put in windfall taxes and stuff like that. We haven't seen it. You can say what you want about Canada. It's, should have been developing more pipelines and et cetera and takeaway. But, the rest of it has been stable with what, in our day to day. But so that was important. And the other one is we trade at low valuations. It's a great place to come compared to the U.S., compared to some other companies. Maybe not as much international trade. They trade similar to us now, but we are trading at lower valuations, specifically, I would say, to our U.S. counterparts. So they look at this as a good place to start their next venture. And we are very strategically aligned on how to do things. And, it'd be much more similar to what Ithaca they were involved with and how that occurred.
Maybe could you give some insights into oil and gas prices? Obviously, they've been volatile, both WTI and AECO, to be honest. So maybe could you give us some insights to that, and also where you see them heading going forward?
Yeah, I mean, like right now, my view is we're going to be in the low 60s for a little while, give or take. Same old, lots of noise, tariff noise. Got to get through that. The geopolitical stuff is still there. I mean, if that goes the wrong way, then you're going to be back seeing $70, etc. But there's a lot of noise about with the OPEC Plus bringing their production on and potentially some slow demand growth over the next year that we should have depressed oil prices. I honestly think OPEC Plus bringing on the production is going to be a bullish term sometime in 2026 because it's starting to show the cracks. And the extra production in there looks more like it's 2 million barrels, not the 3 or the 4 or the 5 that some people said were available. It looks like it's a lot less than was originally predicted. So that's going to be great for oil prices. And I believe, we're managing a great year. We're paying down debt. We're paying our dividend. And you're going into next year. And when that starts changing, we're going to be kicking it, I guess, is, what I'll say. Gas prices, okay, another story. I'm not as bullish on gas prices in Canada. It's just same old. Takeaway capacity, of course, we do have LNG Canada coming on right now as we speak. And this first segment is supposed to be about 1.8 BCF a day. So that's about a 10% to add to our current production in Western Canada, which is great. I think it does bring up our pricing a little bit. I think, ultimately we should start averaging more like 250 to 350 through the year as a longer term number. I get a little bit, not frustrated, but we got these gas guys with world-class plays in the Montney and the Duvernay, but the discipline from these guys tends to be weak at times, and they just grow. We go, we got liquid, so we can grow the gas. And these are world-class plays with large gas in place, and they can be brought on relatively quickly, and that will start taking up that 1.8 BCF. Well, you know what? Then they can expand that. There's plans in place to double that. Plus, you got 2 other ones coming on. So it'll all help. But there is a lot of gas in Canada. There's a lot of gas in the world. So ultimately, we'll see. And you do have to get more and more to the world markets to balance, where pretty much all of our gas is just being sold in Canada, and what isn't sold here, is going to the U.S. And there's only so much going to the U.S. as well. There are restrictions with pipes and compressors. So, we will hedge gas accordingly as we go forward and how we see fit. It's not our revenue driver. So it's, but we don't need to see 60-cent gas and per GJ. And, like I say, we're hedged over $2 today. So for the rest of the summer on over 70% of it. So
awesome. And regarding MSW, which is differential that you pay from the WTI and the Canadian gas price, light oil price.
Yeah.
What has averaged this year, and what is it forecasted to average, for the rest of the year?
So I mean, right now I think we're in the kind of high $2 per US dollar MSW. I think it's still around $3 for Q3, but right now it's showing a little over $4 for the fourth quarter. We'll see where it goes, but MSW it's a funny market. It's not a very liquid market. The sellers are not in control of that. The buyers are more in control of the value of MSW.
Okay, but still good. I mean, it's not 8 or 10. It's more.
It's great. Oh yeah,
it's great.
Yeah.
That's great. $3.
I mean, typically you have spikes into higher numbers when you have a pipeline break going to the U.S. or something like that. We've seen over the years. So that's generally where you have really huge it's got too much for the pipe system. Well, even offsetting some heavies, down to the West Coast now, with the Trans Mountain pipeline reduces volume on the other systems. So, generally you'll see lower pricing, I think, or this type of pricing for the long haul.
And what quality differential do you expect compared to the MSW for your oil on average?
Yeah, so I mean the MSW differential is typically in US dollars. It's a differential to the for transportation to the US, the main place where our oil goes. But on top of that, we have a quality differential on in Canada. So the MSW price gets us to give or take Edmonton. And then, quality is mostly we have a tiny bit of sour in most of our gas, and it could be anywhere between $1.50 to $2.25 Canadian on the quality differential.
Just quickly here also on NGLs. I mean, you had over 40%, 11% of the production comes from NGLs. With this acquisition, it seems like your NGLs pricing have gone up. Is that true? And what do you expect is sort of average compared to oil price?
So this acquisition, there's less high cut facilities, so that most of the gas goes to you get about 30 barrels a million of NGLs on this gas. We were closer to 80 barrels per million with our gas. We're going to some other third party facilities, but that doesn't really change the commodity price. That change how much natural gas liquids you have. Natural gas liquids commodity prices change quite a bit, throughout the year. You think oil's volatile, propane, butane, ethane, all of that can be a lot. Pentanes, condensate, it can all be even worse. And we don't have a ton of condensate and pentanes, but those typically trade at a premium to MSW. But bottom line is it's really volatile. We're forecasting $36 per barrel of NGLs on a blended basis for the rest of the year right now.
I mean, right now your production was 19,400 as you reported in Q2, or as the time when you reported Q2 in mid-August. Well, if oil prices remain around $70, per barrel WTI and around $2 to $3 per MCF AECO, what production rate will you target from next year onwards, really?
Yeah, I mean, I guess it's simplest to say $60 in the low 60s. It's generally a stay or flat model. $70 is a good number to start showing growth, and your strip pricing in the 70s. You're probably in that 3 to 5% range, give or take. And then maybe at the lower end, but that's kind of our view there. You get above $80, and then you're probably looking at the higher end of that 3 to 5% range. So I guess that's the simplest way to describe our capital allocation. There's not a lot like at $60. You see it in the world. You see it in the Permian, where everybody's talking they need $65 to break even full cycle now. There's not a lot of incentive to show growth at $60 right now. And the good thing is I don't believe we're going to be at $60 for too long. So,
but essentially, I mean, even with higher oil prices, there will be modest, like low single-digit low growth. But unless oil prices really go off the shore, to be honest, really, there's isn't almost any environment where you like have significant growth, like spend a lot of capex on drilling.
Yeah, I think. I mean, I think you gotta be just disciplined, right? I mean, if oil goes high, it could be geopolitical. It could, it all relates to supply and demand. But I mean, hopefully, oil's going higher at some point because of demand, and the geopolitical noise is less. So then you get a better view of it. So then you want to grow, but I mean, I've seen this too many times. You grow too fast, your declines go up. We oversupply the world, and prices are too high. You got demand destruction at the same time, and it takes off on you. I mean, what better time, I guess, at $80 oil to show reasonable growth? If you look at 22, pay down a ridiculous amount of debt, and if price comes down, set yourself up to do great accretive acquisitions again, like we just did, right? So that's how we view things. I mean, we went from $4 for something to $5.50, $6 AFF per share with this acquisition. If I can keep doing those, we'll do just fine.
So if you want to maintain production around 19,000 barrels per oil equivalent per day, what kind of capex range do you have to be in to sustain that? And you need to spend, money on infrastructure upgrades, facility maintenance, and so on.
Yeah,
so include
good question. I mean, it'd be around 70 million, give or take, is our stay flat maintenance capital.
So capital allocation priorities going forward, it's paying down debt, and you will also maintain the dividend, and that's
the first priority. Yeah, like I say, we're trying to get below 1 times as soon as possible, right? And just gives us lots of flexibility there. We'll keep paying it down, but I mean, there's potential at some point where you could see us do some share buybacks if we think that's a reasonable option for us as well, and there could be special dividends put on at times too. Like we'll have all those levers available to us, and we make those decisions accordingly.
What room do you see for further consolidation in the Cardium formation?
I mean, there's still lots available there. I mean, and Cardium's important, but again, we won't look just in the Cardium. We'll look at other predominantly, I would think, conventional type assets in Western Canada. We got a good base of knowledge throughout it all, and I think now we've got good partnership with people that are going to be helping, continuing to acquire on a few fronts, which I hope you'll be able to see over time. And I think it gives us a massive, again, access to debt and equity is still difficult. It's not easy, especially for the smaller size companies. To have someone who believes in what you're doing, and you got a 30-some% order sitting in there on anything you do is a great place to be, and I think it's a huge advantage for us over the most of our peers.
And so, in my final question, then, where do you envision InPlay Oil in 2 years from now?
I don't know. I don't know. In reality, I think we can be 40 to 60,000 barrels if things go well, and people change their tunes a little bit, and there's no doubt that larger seems to be better, and you get more eyes on you and more institutions on you, and it should be a priority for most people. So we'll see where it goes, but that's my estimate at this point in time.